What I like about this question is the fact that we ask journal entries, because very often you can figure out how a statement of changes in equity looks like and how it works. But as soon as I ask you the journal entries that is behind those entries, then suddenly you haven't got a clue what to do. So therefore, I like to ask journal entries, and probably in one or other class test, you're going to get journal entries so that I can see that you really understand what you're doing. Now, this is also the first question that you have, where the dividend is paid by ways of a capitalization issue. It's very important that you understand what that is all about. So Entertainment Plus is a large South African company that brings music groups from around the world to perform in venues across South Africa. The authorized share capital, and that is all no par value shares, is as follows. 500,000 ordinary shares, 1.5 million 8% compulsory redeemable cumulative preference shares. We treat this as loan capital. And the 8% dividend applicable on that loan capital will be treated as interest. And then 1 million 9% non-cumulative convertible preference shares, that is equity. The following balances appeared in the records as at 30 September 2012. Now let's just find out what they want us to do. Required. Prepare the necessary journals to record the share issue handled by and underwriters for the year ended 30 September 2013. Prepare the journals to record the declaration and subsequent payment of dividends for the year ended 30 September 2013. And prepare the journal to record the redemption of the 8% redeemable shares as at 30 September 2013. Great. Now with that in the back of our minds, let's go back to this. So this is opening balances. Declared ordinary share capital issued at R4.10 a share. Now guys, immediately we can work out the number of shares. So 9,020,000, the total share capital divided by R4.10 a share, means that in issue there were 2.2 million ordinary shares. 2.2 million, let's just put this like that, then we can all see what we're talking about. 8% compulsory redeemable cumulative preference shares, 750,000 in total. It was for 600,000 shares. So now we can determine what is the issue price, and the issue price was R1.25 then per share. 750,000 divided by 600,000. 9% convertible shares, the total value of that capital, 600,000, and that is capital, that is loan. We had a revaluation reserve and we had retained earnings. Now on 1 October 2012, the company began negotiating to bring in additional 3 famous artists to the program for 2013. They soon realized that there would be need for substantial upfront financing for these events, although they were confident that profits would be made. In order to raise additional funds, they offered shares to the public, which were handled by underwriters, who charged a commission of 4% on the total value of shares. On 15 October, the following shares were offered: 1.2 million ordinary shares of R4.40 each. Now, if we work that out, well, how much do you want to raise? 5,280,000. And then 500,000 9% convertible pref shares at R2.60 each. So how much do you want to raise there? 1,300,000. By 20 November 2012, underwriters had received applications for 1,150,000 shares and 525,000 9% convertible pref shares. So clearly there was an undersubscription on ordinary shares and an oversubscription of preference shares. Now what happens if there's an underwriter? Was there an underwriter? Yes, there was. Who was it? Underwriters. Who received the money? Underwriters. On that date, so on 20 November 2012, they sent the applications and a check for the full amount owing. underwriters also paid their portion of the shares they took up on this day. So the monies for the applications were accumulated by the underwriters, and it was only on the 20th of November on which they have actually done what they're supposed to do with this monies that they have received. On 1 December 2012, the directors allotted the shares and paid underwriters. It is the policy of the company to write off any share issue costs and commissions through declared capital. Great. So basically, what comes into mind is that on the 20th of November, things has happened. The application date is closed, and we have accumulated all these monies. underwriters actually have accumulated the money. How much money? Well, because there was a shortfall under the applications received for the ordinary shares. They wanted to issue 1.2 million, they only received 1150, but they say here that underwriters also took up on that date their portion of the shares. So how many ordinary shares then did we receive applications for? The full 1.2 million. So therefore, the full 1.2 million multiplied by 440 equals 5280. We actually received 525,000 applications for the convertible pref shares. So there was no shortfall, but they have accumulated in the bank account applications for 525,000 preference shares at R2.60 each. So that gave us a total of 1365. So in the bank account was the 5280 for the ordinary shares and the 1365 for the preference shares, which makes up then a total received of 6645 in the bank account. Now, in our application and allotment account, we have to have two separate accounts for every class of share. So we would have had an application and allotment account of ordinary shares for 5280, broken up by 5060 received from the general public and 220,000 received from the underwriter. And then an amount of 1365 for our application and allotment account for our convertible preference shares on 20 November. Now guys, whenever you have to do journal entries, please do them in date order, because you will see that this is quite important, and especially with companies where a lot of things happens consequently or consecutively. The one thing happens after the other thing, after the other thing. If you do not keep the sequence right, you are going to make mistakes, because the one figure depends on the previous figure, and that is all time-based. So make sure whenever you do journal entries or entries in your statement of changes in equity, that you are keeping it by date order. Right now, the 1st of December, we said the directors have allotted the shares. So when they allotted the shares, we had to clean out the application and allotment account, the one for the ordinary shares and the one for the preference shares. Now, we would have allotted the full amount of the ordinary shares, because remember there was a shortfall, so to bring it up to the amount that we wanted to raise, the underwriter had to take up the shortfall. So ordinary share capital would have been equaled exactly to that amount. But we received an oversubscription of 25,000 shares at R2.60 on the preference shares. We could only allot 500,000 times R2.60, which equals 1.3 million. So we can only credit our preference share capital account with 1.3 million rand. The 25,000 times R2.60 oversubscription that we have received, we have to pay back to the applicants. So therefore, bank, the oversubscription, 25,000 times R2.60 equals 65,000 rand. Good. Then we had to pay underwriters' commission, and that also happened on the 1st of December. So underwriters' commission would have been based on the total value of the capital that they wanted to raise. How much did they want to raise? They wanted to raise 1.2 million ordinary shares at R4.40 each and 500,000 preference shares at R2.60 each. So the value of the capital that they wanted to raise was 6,580. And based on that value, we're going to pay underwriters' commission of 4%. So we're going to debit our ordinary share capital account. Why? Because the question says, it is the policy of the company to write off any share issue costs and commissions through declared capital. So therefore, we're going to debit our ordinary share capital account with the amount of 263,200, and we're going to credit bank with 263,200 the amount that we're going to pay the underwriters. Good, then dividends. We've done the first part now. The second one is prepare the journals to record the declaration and subsequent payment of dividends for the year ended 30 September 2013. Now, on 5 September 2013, the company declared dividends of 60 cents per ordinary share, payable to the shareholders on 30 September 2013, right at year end. At the end of September 2013, it was approved that 70% of the dividends payable would be through the issue of 349,453 ordinary shares. So what does that mean in plain simple English? It means that they've declared a dividend of 60 cents per share. So all you have to figure out is how much dividends was going to be paid at that point of time. So there was 2.2 million shares. They've issued another 1.2 million shares. And here they had 600,000 9% convertible shares, and then they issued another 500,000 9% convertible shares. So based on that, there's a 9% dividend on the convertible shares, and based on the number of ordinary shares in issue, they are going to pay 60 cents per share. 70% of the dividends payable, they don't tell you there's 70% of the ordinary dividends payable, they tell you 70% of the total dividends payable. Why? Because I can only declare an ordinary dividend once the pref dividend has been declared. So those equity shareholders, the pref shareholders is also equity shareholders, they are also eligible for dividends. So therefore they are also going to receive a capitalization issue. How much is going to be settled by ways of a capitalization issue? 70%. So 30% is going to be paid in cash, 70% is going to be a capitalization issue. The remainder was settled in cash. Important. So 30%, let me do that, is going to be settled in cash. Withholding tax on dividends will only be paid in the next financial year. Now, here it is very important that you realize that the 20% withholding tax is only applicable on cash dividends. Only applicable on cash dividends. So the 70% is not subject to dividend withholding tax because they are going to receive shares in return for the dividends that they were entitled on. So if a company does not have enough cash resources to pay its dividend, but he goes ahead and he declares dividend like here, and he decides but he's not going to pay that shareholder the dividend that he owes him in cash. He's rather going to give him share certificates to the amount of the dividend that he owes him. Then there is a dividend capitalization issue that's taking place, and there's no dividend withholding tax applicable on the capitalization issue that has to be taken place. All natural persons, all shares are held by natural persons, so therefore the split on our dividend that's going to be declared is going to be the full 80%, 20%. So guys, the first thing that we have to determine is what is now the amount of dividend payable before we can carry on with the rest of the calculation. Now on the ordinary shares, initially we said we had 2.2 million shares in issue. Remember we worked it out here. We said it's that 2.2 million plus that 1.2 million issue. So 2.2 million plus the 1.2 million fresh issue of shares multiplied by the 60 cents a share gives us an ordinary dividend of 2040. On the 9% convertible shares, now the first amount which was in issue for the full year was the 600,000. So they must get 9% shares. Then the additional share capital, the 1.3 million, which was a fresh issue of shares, those shares were only allotted on the 1st of December. So 30 September, the end of the financial year, would have then means that those shares were in issue for a period of 10 months for the year. So on the 600,000 times 9%, the full dividend of 54,000 must be declared. And on the new share issue, the 500,000 times 2.60 rand, so 1.3 million rand, times 9%, those shares were in issue for a period of 10 months for the year. And that then gives us 97,500. So the total dividend that was declared at this point of time was 2,191,500. Now in our statement of changes in equity, when we're actually going to record dividends, we are going to record the full 2,191,500 as a reduction against retained earnings for dividends declared for the year. This capitalization issue has got nothing to do with the amount of dividend that we declared for the year, but it has everything to do of how we're going to pay the shareholder, how are we going to settle that amount of 2,191,500. Now we said that we're going to settle that amount of 2,191,500, 70% of that by ways of a capitalization issue, by giving him share certificates. And the value of those share certificates is then basically going to be 70% of that amount, which equals 1,534,050. 30% of this dividend that we have declared, we are going to settle by ways of cash out of our bank account. So cash dividend is going to be 30% of the 2,191,500, which equals 657,450. Now that amount we have to pay 20% dividend withholding tax on. So that times 20% will give us the amount we have to pay the receiver of revenue of 131,490. So 657,450 times 20%. So the cash dividend multiplied by 20% is going to be paid to SARS, and the cash dividend multiplied by 80% is going to be paid directly to our shareholders. So now if we have to do the general journal entry, we're going to debit dividends or retained earnings at 2,191,500, the full amount of the dividend payable. Then we are going to credit our ordinary share capital, declared share capital amount, with a 70% portion, 1,534,050. Ordinary declared share capital, ordinary share capital account, 1,534,050. How much are we going to pay the shareholder? There we've worked it out. Shareholders for dividends, 525,960, and receiver of revenue for dividend withholding tax, 131,490. Now remember, we also had redeemable pref shares. Now the redeemable pref shares, that dividend by implication was also now declared, so we have to pay that interest on that pref shares that was issued. We had in issue 750,000 rand worth of 8% compulsory pref shares. So going back here, our interest portion is going to be 8% on the 750,000. So we're going to debit our interest expense in the statement of profit and loss. And that is going to be 60,000 rand. and we're going to pay that directly to the holders of the redeemable pref shares. So the redeemable pref shareholders is going to be credited with the amount of 60,000 Rand. Now we're going to pay them. So now we're going to debit shareholders for dividends, 525960. We are going to debit our redeemable pref shareholders, there, 60,000 Rand, 60,000, and we're going to credit bank with the sum total there of 585,950. We must also pay the receiver of revenue. So we are going to debit SARS withholding tax 131,490, and we're going to credit bank 131,490. I could have combined, obviously, that journal transaction. Now, the last part of the question is all about the redemption of shares. Immediately after the payment of dividends, the company decided to redeem all the 8% redeemable pref shares at a price of R2.30 per share. It is the company's policy to use retained earnings as far as possible to redeem shares. Now guys, the first thing is we are going to pay back the amount of the original amount, 750,000. So we said that we have issued those shares at R1.25 per share. When we're going to pay it back, we're going to pay them back R2.30 a share. So the initial issuing of those shares was 600,000 shares at how much? At R1.25 a share, and that made up the total amount which was issued of 750,000, which is also in your trial balance, 750,000. Now we're going to redeem those shares, and when we're going to redeem those shares, we're going to pay them R2.30 a share. So when we're going to repay them back, we're going to pay them an amount of 1,380,000. So obviously the difference between the original amount that they have invested into the entity, the 750,000, we are going to repay them now a premium. And the premium is the difference between the two. Now the premium is then equal to an amount of 630,000 Rand. 1,380 less 750,000. Great. Now this we have to use the retained earnings as far as possible to redeem the shares. The first thing that we're going to use is the actual capital account. So that will come out of the redeemable capital account, the loan account basically for redeemable pref shares. And the premium amount, the premium that we're going to pay them with the redemption of the shares, that is going to come out of retained earnings. So let's have a look how we're going to do that transaction. We're going to debit the capital account with a capital that we can utilize, the 750,000. So that first 750,000, which was lying in the capital account, we're going to debit the capital account then with that amount. Then we're going to debit retained earnings. So retained earnings will then be debited with 630,000. How much do we pay them back? We pay them back 600,000 shares at R2.30 each. So the amount that's going out of our bank account is going to be an amount of 1,380,000.